When people glance at the national debt ticker, whether on a financial website or on a screen in Times Square, the number often feels abstract. It moves so quickly and has grown so large that it stops registering as something real. Tens of trillions of dollars do not fit into normal human intuition. They are too big to visualize, too distant to feel immediate. For years, that disconnect has allowed the conversation around this debt to remain strangely relaxed. The assumption was that as long as the economy kept expanding, the debt would take care of itself. That assumption no longer holds. What has changed is not simply the size of the debt, but how it interacts with the government's budget. Interest costs, once a background detail, have moved to the foreground. The United States now spends more each year servicing past borrowing than it spends on national defense. That single fact represents a structural turning point. Interest is no longer a manageable line item. It has become one of the dominant forces shaping fiscal decisions. Unlike discretionary programs, much of the federal budget cannot be easily reduced. Social Security, Medicare, and other entitlement programs are embedded into the political and social fabric of the country. They were designed for a demographic reality that no longer exists and funded under assumptions that no longer apply. As the population ages, these commitments grow automatically, regardless of economic conditions. Cutting them is politically radioactive. Raising taxes aggressively enough to offset them carries similar consequences. This creates a dilemma that does not resemble household finance. Governments cannot simply tighten their belts and wait out the problem. When interest expenses rise faster than revenue, the only immediate way to cover the gap is to borrow again. New debt is issued not to fund new projects, but to service obligations from the past. Over time, this dynamic feeds on itself. Each round of borrowing increases the base on which future interest is calculated. The feedback loop is slow, but relentless. Historically, countries facing debt burdens of this magnitude have had three broad options. The first is austerity. Sharp tax increases combined with deep spending cuts. In theory, this restores balance. In practice, for a country the size of the United States, it would likely cause a severe economic contraction. Pulling trillions of dollars of demand out of the economy in a short period would ripple through employment, consumption, and investment. Modern political systems rarely survive that kind of shock. The second option is outright default, refusing to honor obligations. While some nations have taken this route, it carries consequences that extend far beyond domestic borders. U.S. Treasury securities sit at the center of the global financial system. They underpin banking reserves, pension portfolios, and international trade settlement. A formal default would not simply harm U.S. credibility. It would destabilize financial institutions worldwide. For a country that issues the world's primary reserve currency, this option remains effectively unusable. That leaves a third path, one that does not involve missing payments or openly breaking promises. Instead, the debt is repaid in full, but in money that gradually loses purchasing power. This approach does not appear as default on paper. Bondholders receive every dollar they are owed. The change occurs in what those dollars can buy. Inflation, when it runs faster than interest rates, reduces the real value of outstanding debt. If prices rise by 5% while the government's borrowing costs remain lower, the burden of the debt shrinks in real terms. No legislation is required. No explicit announcement is made. The adjustment happens quietly, year after year, through the erosion of currency value. This strategy has a long historical record. It was used by the United States itself in the decades following World War II. Interest rates were kept artificially low, while inflation ran higher, allowing the massive war-era debt to be reduced relative to the size of the economy. Savers paid the price through diminished purchasing power, but the process avoided social upheaval and formal default. What makes the current situation different is scale. The absolute level of debt is far higher, and the global financial system is more tightly interconnected. Maintaining this balance requires careful coordination between fiscal authorities and monetary policy. Interest rates cannot rise freely without dramatically increasing the government's financing costs. At the same time, allowing inflation to run unchecked risks undermining confidence in the currency. This tension has led to what economists describe as fiscal dominance. In this environment, monetary policy becomes constrained by the government's debt load. Central banks may still speak in terms of inflation targets and independence, but in practice, there are limits to how restrictive policy can become. Pushing interest rates too high would transfer an unsustainable portion of government revenue directly into interest payments. As a result, inflation does not need to be extreme to be effective. Moderate but persistent price increases, sustained over many years, can significantly reduce the real value of debt. Compounding does the work quietly. What feels tolerable in any single year becomes transformative over a decade. For households, the impact is uneven. Those whose wealth is primarily held in cash or fixed income savings absorb the full effect of currency erosion. Those who own assets such as businesses, real estate, or equities often see nominal values rise alongside inflation. This divergence is not accidental. It is a predictable outcome of where new money enters the system and how financial markets respond to it. The process does not require secrecy or deception. It relies on incentives, institutional design, and gradual adjustment. Most people experience it not as a policy decision, but as a slow shift in what their money can buy. Prices rise, savings feel less effective, and long-term planning becomes more difficult. Meanwhile, the debt remains technically serviced, even as its real weight declines. This is how large debts are erased without being explicitly paid down. Not through dramatic announcements or sudden crises, but through time, inflation, and the steady reshaping of financial realities. The mechanics behind this quiet debt reduction are not mysterious, but they are rarely discussed in plain terms. They operate through institutions most people never interact with directly, using rules that feel technical and distant. Yet these rules shape the financial reality everyone lives in. In a truly open market, a borrower with a rapidly growing debt load would face rising interest rates. Lenders would demand compensation for increased risk. This feedback mechanism is how markets normally enforce discipline. Governments, however, do not operate under the same constraints. They write the rules that define risk, liquidity, and capital requirements for the financial system itself. Modern banking regulation classifies U.S. Treasury securities as the safest assets available. Banks, insurance companies, and pension funds are required to hold them in large quantities to meet regulatory standards. These institutions are not choosing treasuries purely because of their return. They are choosing them because they are required to do so in order to function legally. This creates a permanent pool of buyers. Even when yields are low and inflation is high, demand remains. The market signal that would normally force borrowing costs upward is muted. The government can issue enormous quantities of debt without triggering the same reaction that would confront a private borrower. At the same time, the way inflation is measured plays a crucial role. Many government obligations are indexed to inflation. Social security payments, certain wages, and inflation-protected securities all rise based on official inflation figures. The higher the number, the higher the cost to the government. Over time, the methodology used to calculate inflation has evolved. Changes in consumer behavior are assumed. Quality improvements are factored in. Substitutions are made. These adjustments are often defended as reasonable refinements, and in isolation, many of them are. But the cumulative effect is that official inflation figures tend to rise more slowly than the lived experience of many households. When official inflation runs lower than perceived inflation, the gap benefits the issuer of debt. Obligations rise more slowly, while real purchasing power erodes more quickly. Again, no single decision creates the outcome. It emerges from layers of policy choices interacting over decades. Another key element is the role of the central bank as a stabilizer of last resort. When private and foreign demand for government debt weakens, the central bank can step in. By purchasing bonds directly, it supports prices and suppresses yields. This process increases the money supply, but it also ensures that financing costs remain manageable. This intervention is often framed as temporary or exceptional, used only during periods of stress. In practice, it has become a recurring feature of the financial system. Each time markets show strain, central bank balance sheets expand. Each expansion makes future contraction more difficult without causing disruption. The result is an environment where asset prices are highly sensitive to monetary conditions. Stocks, real estate, and other financial assets respond quickly to changes in liquidity. When money is abundant, prices rise. This creates the appearance of growing wealth, even if underlying productivity has not changed at the same pace. For those who own these assets, inflation feels manageable or even beneficial. For those who rely primarily on wages and savings, it feels very different. Costs rise faster than income. The value of accumulated savings diminishes. Long-term financial security becomes harder to achieve through traditional means. This divergence feeds into broader economic inequality. It is not driven by a single policy or intention, but by the structure of the system itself. When debt reduction occurs through inflation, the burden is spread unevenly across society. Historically, this approach has been politically attractive because it avoids explicit choices. No one votes to reduce the purchasing power of money. No legislation announces a transfer from savers to debtors. The process unfolds gradually, often unnoticed until its effects are well established. The long-term implication is a shift in how people must think about financial stability. In a world where holding cash guarantees loss of purchasing power, safety no longer comes from avoiding risk. It comes from selecting assets that can adjust with inflation. This forces households and institutions alike into markets they might otherwise avoid. At the national level, this strategy buys time. It keeps the debt serviceable. It maintains confidence in formal obligations. But it also locks the system into a narrow path. Interest rates cannot rise freely. Inflation cannot fall too low. Policy flexibility diminishes as the debt grows larger. The debt does not disappear in a dramatic moment. It fades in real terms, year by year, as the currency it is denominated in changes. On paper, the numbers continue to rise. In practice, their weight shifts quietly onto the economy itself. What ultimately matters is not whether the national debt reaches 40 trillion, 50 trillion, or beyond. Those figures are symbols, not the mechanism itself. The real story is how the system adapts to numbers that no longer fit traditional solutions. The United States is not preparing for a dramatic reckoning. There is no single moment when the debt is dealt with. Instead, the adjustment happens gradually, through the value of money, through long-term policy constraints, and through the shifting balance between borrowers and savers. On paper, every obligation continues to be honored. In real terms, the cost is distributed quietly across time. This approach reshapes incentives throughout the economy. Saving in the traditional sense becomes less effective. Stability no longer comes from avoiding risk, but from choosing assets that can adjust as the currency changes. This alters behavior at every level, from households to pension funds to global investors. The financial system becomes less about preservation and more about adaptation. For policymakers, this path offers continuity. It avoids the shock of austerity and the chaos of default. It preserves the appearance of stability, even as underlying conditions evolve, but it also reduces room for maneuver. Once inflation becomes a tool for managing debt, controlling it without triggering disruption becomes increasingly difficult. Each year of reliance makes the next harder to exit. For the public, the experience is subtle but persistent. Prices drift upward. Long-term plans feel less certain. Wealth concentrates in areas that move with inflation, while those anchored to fixed incomes fall behind. These are not side effects. They are intrinsic to how this method of adjustment works. None of this requires secrecy or hidden coordination. It emerges from institutional incentives, historical precedent, and the simple arithmetic of large numbers. The system does what systems always do when faced with constraints. It finds the path that minimizes immediate conflict, even if it spreads the cost over a longer horizon. The national debt, then, is not being eliminated through repayment in the conventional sense. It is being reshaped through time. Its burden is reduced, not by paying it down, but by changing what repayment means in real terms. Understanding this does not require predicting collapse or assuming intent. It requires recognizing that money is not static, and that debt denominated in that money cannot be separated from its value. When the unit of account changes, so does the obligation measured in it. This is how large debts end not with a crisis that arrives all at once, but with a gradual transformation that feels manageable year by year, even as it quietly rewrites the economic landscape. Hey everyone! If you enjoyed this video and want to stay updated with more insights on finance, make sure to subscribe to my channel, Financial Coin, and don't forget to hit that bell icon so you never miss our latest videos.